In this second video of the series on the production creation process, we will be focusing on ways to finance a business. The pros and cons of equity financing and funding a startup. With your product decided and created, it's time to get down to the other requirements, such as finances. The idea is that by the end of the video, you understand what is financially required for your business. Once you have added up all the costs for your business, you can then determine whether you have enough to cover the rest. If you don't, consider getting a business loan. Keep in mind that you will have to repay the loan along with interest. A business loan is one way to finance a business. There are a variety of sources that you can go to for a business loan. Family and friends is one option. The great part about family and friends is that they love and care about you. When they give you a loan for a business, you might not have to pay interest, only the loan. In some cases, you might not even have to repay them. Some family members might take the place of an investor to obtain a certain percentage of the business profit. Either way, start with family first before you go on to anything else. A bank loan is another option, and there are various business loans available through the bank. However, the interest can be very hefty. It's best to find one with a lower interest rate and ample amounts of money that they can loan to you. Investors' equity financing is also an option. Bitcoins and cryptocurrencies have a lot of investors that are willing to fund innovative business and products. You can also find investors from the venture capitalist. The good part about this is that with these investors, you won't have to deal with interest rates. All you have to do is pay a certain percentage of your profit to them. With equity financing, although you don't have to pay them back, per se, you do have to pay your investors eventually. But instead of making monthly payments with interest, you'll only compensate them if your business succeeds and you start making money. At that point, you give your investors a previously agreed upon percentage of your profits for the life of your business. Unless, of course, you make so much money that you're able to buy them out sooner. Another positive with equity financing is that there is no liability if the business doesn't succeed. The investors are the ones who take the hit, not you or your family. You probably won't need to make monthly payments until you make a profit. Which means you keep more cash in your pocket while you get things up and running. The cons of equity financing are that the investors own a portion of your business. Depending on your particular agreement, they may be able to have a say in your day-to-day operations, including how you spend the money that they've invested. Depending on who your investors are, and how their vision for the business aligns with yours, this can be no problem at all, or a major pain in the you-know-what. Of course, there are other ways of funding your startup. Such as pursuing a grant. While you shouldn't expect to be cut a massive check, there are dozens of grants available. These are offered by governments as well as private enterprises, in the interests of stimulating the economy and growing the jobs market. These financial injections can help you save money on various things, like premises, purchasing cheaper IT or manufacturing equipment, and funding staff training. The main drawback is the fierce competitiveness of such grants, as well as the box ticking involved. It can be a frustratingly drawn-out process, but that's the trade-off for retaining equity. Another funding option is crowdfunding. It is a favorite of the digital economy, and probably the quickest way of obtaining finance for a new business. You don't even have to be massively tech-savvy to launch a crowdfunding campaign, but what you do need is a compelling pitch, one which strongly references your startup's potential for growth, as well as a knack for interacting with your cash-rich community. If successful, you'll have capital that you don't need to pay back, without ceding any operational control. It is also a nifty form of advertising and a way of stimulating interest in your company before it's even made its debut. It is clear there are various options when it comes to funding your business. It is now up to you to decide which option best suits you and your business needs. This video has hopefully given you some food for thought in making that decision. In our next video, the third in the series, we will discuss networking. Please be sure to watch, as it is a vital part of your business success. Thank you for taking the time to watch this video. Please like and share if you have found the content valuable, and refer to our links in and around this page for more useful tips on business financing.